The report sought to characterize tax flight as a myth and an unproven one. There are many reports actually, or many studies out there that do verify the fact that people respond to tax incentives in their migration decisions. And the best study I brought up was one from the Mercator Center, which measured economic and personal freedom across the states. And over a period of 10 years, there was a disparity of about 6% in terms of population migration between the states. That's to say that the economically oppressed or more over-governed states lost around 3% of their population, and those that were more economically free gained about 3% of their population. And I mean, I don't know. Well, the problem is that the actual tax discrepancies between states are not that great. They tend to be just 1 or 2% of your total income. So that means that actually gauging the level of flow can be difficult because there are lots of things going on at the same time. We're dealing with correlation. The easiest, really, we don't even, well, there is evidence there that people are shifting in terms of different policies, but the basic logic speaks for itself, really, that people respond to incentives. Just as people move for lower housing costs to a certain region, they also move for different tax rates. But there's a deeper problem with the report that I want to point out, that there's the assumption that if people cannot escape a tax, or we can increase our tax revenue, then it's a good idea to do so. You know, I don't agree with that. That just because we can tax people, it's a good idea. There are all sorts of other consequences from increasing taxes as well. We create compliance costs. Those taxes become vulnerable to as tools to micromanage us, to push or change our resource allocations. And as I mentioned earlier, they have impacts on investment decisions too.